Have you ever wished for a sneak peek into the future of the stock market? Well, if you have, you're in the right place. Michael Burry, the genius from The Big Short, who also predicted the housing bubble burst, might just have the key to understanding the 2023 market crash. Let's get right to it. Who even is Michael Burry? The story of Michael Burry is no ordinary one, as you're about to see. Michael, growing up in California, was a young, curious lad who was especially fascinated by numbers. Now, he wasn't your average kid. While other kids were trading Pokemon cards, he was trading stocks. Yes, he started investing at a tender age, showing a knack for numbers that set him apart. Fast forward to adulthood, he's on the path to becoming a doctor. Medical school was fast beckoning, but so was finance. He just couldn't ignore that itch for stocks. He decided to pivot from medicine to finance. Bold move, right? Michael founded Scion Capital in the early 2000s, his very own hedge fund, and thus began his journey into the world of investing. But let's talk about a moment that would be a turnaround for him: the mid-2000s housing bubble. While everyone was riding high on the housing market, Michael was digging deep into the numbers. And guess what he saw? An impending disaster. He saw the housing bubble for what it was: a ticking time bomb. He decided to go against the tide, betting against subprime mortgages when everyone was singing praises to the housing market. Result? He was spot on. The market crashed hard in 2008, and Michael's predictions paid off big time. This was his Big Short moment, immortalized in the movie. But Michael's success story didn't end there. He's worked with some reputable names in the finance world. He was a notable player at companies like Stanford Hospitals and Vanguard Group. And here we are in 2023. Michael's sounding alarms again. People are listening, as they should. He's got a track record that's hard to ignore. Decoding his crystal ball isn't just about luck. It's about understanding his method, his analysis, and how he spots trends that others often miss. That's what we're here to unravel. Michael Burry's genius and insights that might just give us a peek into what's coming in 2023. Now, what are the 5 insights Michael Burry offers in his latest prediction? Well, here they are. A repeat of the 2008 financial crash is looming in 2023. Famed for predicting the 2008 financial crisis, Michael Burry has sent shockwaves through the financial world by hinting at a potential 2023 market crash. In a series of cryptic tweets, Burry dropped hints that mirror his pre-2008 warnings. He flagged concerning parallels in today's market conditions and those that led to the 2008 crash. Burry highlighted excessive speculation, risky spending, and overvalued assets as key indicators. He drew attention to the booming housing market, resembling the pre-housing crisis era, where inflated housing prices and subprime mortgages were a ticking time bomb. He warned about the speculative frenzy around meme stocks and cryptocurrencies, expressing concerns about their inflated values. Furthermore, Burry emphasized the impact of government policies and fiscal measures on the market, drawing parallels to the pre-2008 era when government interventions inadvertently worsened the crisis. He cautioned about potential unintended consequences of current monetary policies. Also, Burry believes that banks are on a dangerous tightrope because they are leveraged too much while being short on capital, a situation that echoes pre-2008 woes. Risky loans and bloated assets ring familiar bells. This foresight from the Big Short guru suggests a looming storm in the financial landscape. Inflation has become a mainstay in the economy. Burry took to Twitter, his favorite platform for dropping financial truth bombs, to outline his concerns. In a series of tweets, Burry argued that the massive amount of government stimulus injected into the economy could trigger a nasty bout of inflation. He highlighted how this flood of money might cause a rise in prices across the board, from essential goods to assets like real estate. Essentially, too much money chasing too few goods could lead to a cost surge. He pointed out that while inflation is expected during a recovery, the sheer scale of the current stimulus measures might overheat the economy, causing a persistent inflationary trend. Burry cautioned that this could potentially spiral out of control, impacting savings and investments and creating a ripple effect through the markets. Burry's concern stems from historical precedents. He compared the current situation to the 1970s, a period infamous for stagflation, a combo of stagnant economic growth and high inflation. He hinted that we might be on a similar path if precautions aren't taken. This isn't just an economic theory, it's a warning. Burry's track record for spotting financial storms is formidable. His tweet storm isn't just noise, it's a forecast. So whether you're an investor or just keeping an eye on the economy, it might be wise to heed his words and prepare for potential economic turbulence ahead. Also, Burry's prediction of entrenched inflation gains weight considering recent economic statistics. The Consumer Price Index, CPI, a key measure of inflation, surged by 5.4% in July of 2021 compared to the previous year, marking the highest increase in nearly 13 years. Furthermore, the Producer Price Index, PPI, an indicator of wholesale prices, climbed by 7.8% in the same month, showcasing the ripple effect across supply chains. Burry's concerns align with these real-world numbers, reinforcing the worry that inflation may indeed become a persistent economic challenge, impacting the purchasing power of consumers and the stability of the market. The stock market will decline as it did in 2022. So, what's the deal with this leg-down prediction and the skepticism about buy the dip? Michael Burry, the man with the numbers, is sounding the alarm. He's pointing to patterns resembling the 2022 downturn, suggesting we might experience a similar market leg down in 2023. Burry doesn't seem to approve of the buy the dip strategy either. He's critical of it. That means that mindset of buying during market dips might not be as bulletproof as it seemed in the past. It's a gamble, and sometimes the house doesn't play nice. In his recent tweets, Burry has been highlighting potential vulnerabilities in the market, indicating that things might get bumpy. He's pointing towards various factors like inflation rates, global economic shifts, and possibly overheated sectors that could contribute to this looming leg down. Now, let's talk numbers briefly. Inflation rates have been edging up, causing concerns. In the first half of 2023, inflation soared by 5.4%, the highest increase since 2008. Rising interest rates are also putting pressure on certain sectors. For instance, the tech-heavy NASDAQ has experienced noticeable fluctuations, and it's something we need to watch closely. Basically, what he's trying to say is that the markets are on shaky ground, and it might not be a smooth ride ahead. Burry's insights are painting a cautionary tale, urging us to be vigilant and think twice before diving headfirst into market dips or to stake on it. Still watching? Don't miss out on the most important bit about the housing crisis right at the end of this video. Banks are over-leveraged and vulnerable to shocks. I briefly mentioned this earlier, but I'll be expanding further now. Burry's been waving red flags, shouting from the Twitter rooftops about how our beloved banking system might just be playing Jenga with too many blocks. You see, over-leveraged is the key word here. Imagine stacking too many bricks on a wobbly foundation. That's what's happening in the banking world. In his tweets, Burry's been pointing out that the banking system is dangerously over-leveraged, meaning they've borrowed too much money compared to the actual assets they hold. This leverage amplifies risks. When the market shakes, it can cause a financial earthquake. He's been mentioning the debt levels of major banks, signaling that they might not be able to handle significant shocks. Now, let's peek at some numbers. The debt-to-GDP ratio for the United States hit a staggering 130.45% in the first quarter of 2023. That's a hefty debt load the country is carrying, and it's not just a standalone issue. It's intertwined with the banking system. Many banks hold a significant chunk of this debt, and if it starts to wobble, the banking dominoes could start to fall. Why is this concerning? Well, when a bank is over-leveraged, even a small downturn can send shockwaves through the financial system. Imagine a domino rally. One falls and sets off a chain reaction. The banking system, as it stands, might not be resilient enough to withstand a major economic earthquake. Basically, the financial sector is walking on thin ice. Burry's not crying wolf for nothing. The banking system is burdened by excessive debt, and if a strong wind blows, things might get dicey. It's like sitting on a seesaw with an elephant on the other end. It's all fun and games until reality comes crashing down. However, for investors who are willing to bet on the movement of the market, this might be something to look out for. Alternative assets will outperform traditional investment. Burry's tweets have been dropping hints about how alternative assets, think real estate, cryptocurrencies, or commodities, could outshine traditional stocks and bonds. He sees a trend where investors might diversify into these alternative options, seeking better returns and reduced volatility. In recent years, for instance, cryptocurrencies have made a grand entrance into the financial scene. Bitcoin, for instance, experienced a meteoric rise with a 200% increase in value in 2021. Real estate has also been a sturdy performer historically, providing consistent returns, often with less volatility compared to the stock market. So the game plan might shift. Diversifying into these alternative assets might be a smart move as markets evolve. It's like choosing a variety of toppings for your pizza. Diversity makes it more flavorful. Burry's insights suggest we keep our eyes peeled for these alternatives, as they could potentially lead the investment charge in 2023. Keep your eyes peeled. In this journey through Michael Burry's predictions, we've gained valuable insights into the potential twists awaiting the market in 2023. Brace yourself for possible market shifts, echoes of the previous years, concerns about the banking system, and the rise of alternative assets. Stay informed, stay agile, and let's navigate the financial waves together. Here's to making wise choices and prospering amidst the market's mysteries. I'll see you in my next video. Cheers.